talk to the direct update first if you are receiving the state pension, universal credit, or any other DWP managed benefit in the UK. The key thing you need to understand right now is that around Easter 2026, your payment dates may be adjusted due to the official bank holiday schedule, meaning some people could receive their money earlier than expected, and others may see their payment arrive slightly ahead of the usual date depending on how the holiday falls within the payment cycle. To understand this properly, it is important to start with how the UK payment system actually works when public holidays arrive. The Department for Work and Pensions, often referred to as DWP, follows a consistent rule whenever there is a bank holiday in the United Kingdom. If a payment date for benefits such as the state pension or universal credit falls on a day when banks are closed, the payment is usually made on the last working day before the holiday. This ensures that claimants do not experience delays in receiving their money, especially during important holiday periods when financial needs can increase. Easter is one of the most significant periods in the UK calendar for payment adjustments because it includes multiple bank holidays that often fall close together. Typically, Good Friday and Easter Monday are both treated as official non-banking days. When these dates fall within a benefit payment schedule, they can shift normal payment cycles forward. This is why many people refer to early payments during Easter. However, it is important to understand that this is not an extra payment or bonus, it is simply an adjustment in timing. For state pension recipients, payments are usually made every 4 weeks, and the exact day depends on the last 2 digits of the national insurance number. This system remains consistent even during holiday periods, but when a scheduled payment date clashes with a bank holiday, the DWP ensures the funds are sent earlier so that pensioners are not left waiting during days when banking services are unavailable. This means that in an Easter week scenario, some pensioners may receive their money a few days earlier than usual, depending on their assigned payment day. Universal credit works slightly differently because it is paid monthly, and the payment date is based on the claimant's assessment period rather than a fixed national schedule. Even so, the same rule applies. If the payment date falls on a bank holiday, the money is usually released earlier. This helps prevent any disruption to essential living costs such as rent, food, and bills, which are particularly important for households relying on this support. Now, when people hear terms like Easter 2026 payment schedule or early DWP payments, it is often assumed that there are special new rules or additional changes being introduced. However, in most cases, these adjustments are part of the long-standing operational procedures already used by the government every year. The system is designed to automatically adapt to public holidays, so claimants do not need to apply or request anything for their payment date to change. Everything happens automatically in the background through the banking and DWP processing systems. One important detail that many people overlook is that receiving a payment earlier does not mean receiving extra money. It simply means the next payment cycle will feel longer because the gap between payments becomes stretched after an early deposit. For example, if a universal credit payment arrives a few days early due to Easter bank holidays, the next payment will still arrive on the usual monthly cycle, meaning the time between payments may feel slightly extended. This is why financial planning becomes especially important during holiday periods. For pensioners, this early payment system can sometimes cause confusion, especially when they see their money arrive before the expected date. It is always important to check official payment statements or bank notifications rather than assuming there has been an error. In almost all cases during Easter or other UK bank holidays, early payment is intentional and part of the standard DWP process. Another key factor to understand is the role of banks in this schedule. Even if the DWP releases funds on a normal processing day, banks may not always complete transactions during public holidays. This is why payments are often moved earlier rather than delayed. The goal is to ensure that individuals have access to their money before the banking system closes for the holiday period. This coordination between government departments and banking institutions is what makes the early payment system work smoothly. Looking ahead to Easter 2026 specifically, while exact calendar alignment will depend on the final bank holiday dates confirmed by official UK government announcements, the pattern is expected to follow the same structure that has been used for many years. If Easter Monday and Good Friday fall close to standard payment dates, adjustments will likely be made automatically. However, it is always recommended to check official DWP notices closer to the date for precise confirmation, as individual payment dates can vary depending on personal circumstances. It is also important to highlight that no action is required from claimants during these periods. There is no need to contact DWP unless there is a genuine issue with a missing or delayed payment outside of the expected holiday adjustment. The system is fully automated, and changes are applied at the administrative level without affecting eligibility or entitlement. As we move further into this discussion, it becomes essential to break down exactly how these payment shifts affect different groups of people, including pensioners, universal credit claimants, disability benefit recipients, and those receiving additional support such as housing-related payments. Each group may experience slightly different timing patterns depending on how their benefit is structured and when their regular payment date falls within the Easter period. In the next part of this video, we will go deeper into the exact way state pension payment dates are calculated, why some people receive payments earlier than others during Easter, and how the National Insurance Number System plays a crucial role in determining your money schedule. We will also explore real-life examples so you can clearly understand how the Easter 2026 payment adjustments may affect your personal situation. If you are finding this explanation helpful so far, the next section will make everything even clearer, especially if you rely on regular DWP payments for your monthly budgeting and want to avoid confusion during holiday periods. Continuing from the earlier explanation, it is important to understand the exact system behind state pension payment scheduling, because this is the foundation of why some people receive their money earlier during Easter periods while others do not notice any change at all. The state pension in the United Kingdom is not paid on a single national date for everyone. Instead, it is distributed across the week in a structured cycle that depends on the last 2 digits of a person's national insurance number. This system has been used for many years to spread payment processing evenly and avoid overwhelming the banking system on a single day. When your national insurance number determines your payment day, it effectively locks your state pension into a predictable rhythm. For example, some individuals will always receive their pension on a Monday, others on a Tuesday, Wednesday, Thursday, or Friday depending on their assigned group. This system continues to operate even during holiday periods like Easter, but the timing can shift slightly when official bank holidays interfere with normal banking operations. To make this clearer, imagine a situation where your normal state pension payment is scheduled for a Friday. If that Friday happens to fall on Good Friday during Easter, that day is officially a bank holiday in the United Kingdom. Banks are closed, and normal clearing systems do not operate in the usual way. In this case, the Department for Work and Pensions ensures that your payment is processed earlier, typically on the last working day before the holiday period begins. This ensures that you do not experience a gap in access to your pension during a time when financial institutions are not operating normally. This adjustment is not random, and it does not vary based on personal preference or application. It is an automated response built into the government's payment system. The goal is always to maintain financial stability for pensioners and ensure that essential income is not delayed during public holidays. This approach reflects a long-standing policy of prioritizing timely access to funds, especially for individuals who rely heavily on regular payments for daily living costs. Universal credit operates on a different structure, but the principle of protection against holiday disruption remains the same. Universal credit is calculated based on a monthly assessment period. This means that each claimant has a specific cycle, usually starting on the date they first applied or were approved. After each assessment period ends, the Department for Work and Pensions calculates the entitlement and schedules the payment roughly 7 days later. This creates a rolling system where payments are not fixed to national dates but instead follow individual timelines. During Easter, if a universal credit payment date happens to fall on a bank holiday, the payment is also moved earlier. However, because universal credit is tied to individual assessment cycles, not everyone will experience a change at the same time. Some claimants may notice their payment arriving earlier in the week, while others may not be affected at all. This is why confusion often arises during Easter periods, as people compare payment experiences without realizing that each claim is calculated independently. Another important aspect to understand is how the banking system interacts with DWP payments. Even when the government processes a payment on time, the actual appearance of funds in a bank account depends on the banking network's clearing cycle. During normal working days, transfers between government systems and banks are processed quickly and efficiently. However, during public holidays such as Easter Friday or Easter Monday, the clearing systems are paused or limited. This is why early payment scheduling is necessary rather than optional. It is also worth noting that early payments do not change the overall amount a person receives. Whether you receive your state pension or universal credit before or after a bank holiday, the total entitlement remains exactly the same. The only difference is timing. However, this timing shift can sometimes create a false impression of financial imbalance, especially for households that rely heavily on strict budgeting cycles. For example, if someone receives their universal credit payment 3 days earlier than expected, it may feel like an extra gap before the next payment arrives, even though the monthly schedule has not changed. To understand how this plays out in real life, consider a pensioner whose normal payment day is Wednesday. If Easter Monday falls in the same week and banks are closed on that Monday, there may be no impact at all on their payment because their scheduled day remains unaffected by the holiday. However, another pensioner whose payment falls on Good Friday will see their money arrive earlier in the week, likely on the Thursday before the holiday. This difference highlights why not everyone experiences early payment during Easter even though the system is applying the same rules universally. This variation is often misunderstood in public discussions about DWP payment schedules. Some people assume that the government issues blanket early payments to all claimants during Easter, but in reality, only those whose scheduled payment dates clash with bank holidays are affected. The rest continue on their normal schedule without any change. This targeted adjustment ensures efficiency while avoiding unnecessary disruption to the entire system. In addition, it is important to consider how financial planning becomes particularly relevant during these periods. When payments arrive earlier than expected, it can sometimes lead to a longer than usual gap before the next scheduled payment. This is not a reduction in income, but a shift in timing that requires careful budgeting. Many financial advisors often recommend that households plan ahead during known holiday periods to ensure they maintain stable access to essential funds throughout the month. Another factor that contributes to confusion is the way banks display transactions. Some banks may show pending payments in advance, while others only display funds once they are fully cleared. During Easter, when processing times are adjusted, these differences can become more noticeable. This is why some people may see their payment pending before it officially arrives, while others only see it once it has fully cleared into their account. As we move closer to understanding the Easter 2026 payment cycle specifically, it is useful to remember that UK bank holidays follow a predictable structure each year. Good Friday and Easter Monday are almost always included, and these 2 days are the primary cause of payment adjustments within the DWP system. When these dates are confirmed officially, the payment calendar is automatically updated within the government's processing systems to ensure smooth distribution. In the next part of this script, we will go deeper into how universal credit calculation periods interact with Easter timing, including detailed explanations of why some claimants may feel their payment cycle has shifted even when no official change has been made. We will also explore how housing payments and additional support elements are handled during holiday disruptions, and why some parts of your benefit may appear separately in your bank account during this period. This will help you fully understand not just when your money arrives, but how each component of your support is calculated and delivered during one of the most important holiday periods in the UK financial calendar. Continuing from the earlier explanation, it is now important to bring everything together so you have a complete and practical understanding of how state pension and universal credit payments may be affected during the Easter 2026 period, and what that actually means for real-life budgeting, financial planning, and day-to-day stability for households across the United Kingdom. When we talk about universal credit during bank holidays like Easter, one of the most important things to understand is that the payment is not a single fixed benefit in the same way as the state pension. Instead, it is made up of different elements that are calculated separately and then combined into one monthly payment. These elements can include standard allowance, housing support, child-related support, disability-related additions, and other conditional components depending on the claimant's circumstances. Even though all of these parts are combined into a single payment, the timing is still based on the end of the assessment period plus a short processing window. This means that when Easter holidays fall within or near the payment date, the Department for Work and Pensions may adjust the release date to ensure that funds are received before banks close for the holiday period. This is done purely to maintain access to essential income and avoid disruption during days when banking systems are not fully operational. However, it is also important to understand that even when the main universal credit payment is moved earlier, there may still be small timing differences in how the breakdown appears in your bank account. Some people may notice that their housing support portion or other elements appear at slightly different times or are included under a single combined deposit. This can sometimes cause confusion, but it is simply a reflection of how banking processing systems handle grouped payments during busy holiday periods. For state pension recipients, the system remains more structured and predictable. Because the payment is based on a fixed cycle determined by national insurance number groupings, most people can expect consistency year after year. During Easter 2026, the only potential changes will occur if your scheduled payment date directly clashes with a bank holiday. If that happens, your payment will be issued earlier, typically on the last working day before the holiday period begins. If your normal payment date does not fall on a bank holiday, your schedule will remain completely unchanged. This distinction is very important because it helps prevent misunderstandings that often arise during holiday seasons. Many people assume that all pensioners or all benefit claimants receive early payments at the same time, but in reality, adjustments are highly targeted and depend entirely on individual payment schedules. The system is designed this way to ensure fairness, efficiency, and stability across millions of accounts. Another key point to understand is that early payments do not affect entitlement in any way. Whether you receive your money before Easter or after it, the total amount remains exactly the same. There are no additional bonuses, reductions, or special holiday increases built into the system for this purpose. The adjustment is purely logistical, not financial. From a budgeting perspective, however, timing changes can have a real impact on how households manage their money. When payments arrive earlier than expected, it can create a longer gap before the next payment cycle begins. This is especially important for individuals on fixed incomes, where even a few extra days can make a difference in planning groceries, utility bills, and other essential expenses. For this reason, financial awareness during holiday periods becomes particularly important. One practical approach that many people use is to treat early payments as if they were still arriving on the original scheduled date. This helps avoid overspending early in the cycle and ensures that money lasts until the next payment arrives. While this does not change the official system, it can help maintain financial stability during holiday-adjusted periods like Easter. It is also worth highlighting how important it is to monitor official DWP communications during this time. While the system generally follows predictable annual patterns, the exact dates for Easter holidays can shift slightly depending on the calendar year. Official government announcements provide confirmation of any changes to banking schedules, and these updates are automatically reflected in the payment processing system. This means claimants do not need to apply or take action, but staying informed helps reduce confusion. In addition, banking technology plays a major role in how quickly payments appear in accounts. Most UK banks now process DWP payments very quickly, often showing funds within hours of release. However, during public holidays, this process may pause or slow down, which is why early release before the holiday is so important. It ensures that claimants have access to their money when banking services are temporarily unavailable. As we look specifically toward Easter 2026, the overall structure is expected to remain consistent with previous years. Good Friday and Easter Monday will likely continue to be treated as non-banking days, and any payment dates that fall on or near these holidays will be adjusted forward automatically. While exact confirmation will come closer to the date through official government schedules, the long-standing pattern makes the system highly predictable for most claimants. To summarize everything in a clear and practical way, the most important takeaway is that there is no need for concern if your state pension or universal credit payment arrives earlier around Easter 2026. It is not an error, not a policy change affecting your entitlement, and not a reduction in benefits. It is simply a standard administrative adjustment designed to ensure that payments are delivered before bank holidays when normal banking operations are paused. Understanding this system helps reduce stress, avoids unnecessary confusion, and allows you to plan your finances more effectively during holiday periods. Whether you rely on the state pension, universal credit, or a combination of different DWP benefits, knowing how and why these adjustments happen gives you greater control over your budgeting and financial planning. In conclusion, Easter payment adjustments are part of a long-established and reliable system within the Department for Work and Pensions. The goal is always to protect access to essential income, ensure smooth banking operations, and support claimants during times when financial systems are temporarily closed. By understanding how these rules work, you can approach Easter 2026 with confidence, knowing exactly what to expect from your payment schedule and how to manage your money effectively during the holiday period.